You've probably been trained to believe that your credit score is the single most important number in your financial life. You check it obsessively, worry about every point, and assume that a higher score automatically gives you better loans, lower interest rates, and instant approval for credit cards, mortgages, or even rental applications. The reality, however, is far more complicated. Your credit score is only part of the story, and sometimes it can outright mislead you about your true financial health. What lenders actually check goes much deeper, and understanding this is the first step toward making your credit work for you instead of against you. Take someone like Mark. He's a 32-year-old professional who's been careful with his finances for years. He earns $5,000 a month and has never missed a single credit card payment. His score hovers around 780, which most people would consider excellent. Mark assumed that this score alone would automatically unlock the lowest mortgage rates when he decided to buy his first home. When he applied, however, he discovered the truth. Lenders don't just look at your credit score. They scrutinize your debt-to-income ratio, your employment history, the stability of your income, your recent credit inquiries, and even the type of accounts you hold. As a result, he didn't qualify for the ultra-low interest rate he expected. That was when he realized a credit score can lie about your true borrowing power. Here's the first big fact most people get wrong. Lenders care about risk, not just numbers. Your credit score is supposed to reflect the likelihood you'll repay debt responsibly, but it doesn't account for all factors lenders see as risk indicators. One of the most critical is your debt-to-income ratio, often abbreviated as DTI. This is calculated by dividing your monthly debt obligations by your gross monthly income. For example, if you earn $5,000 per month and have $2,000 in recurring monthly debt, including car loans, student loans, and minimum credit card payments, your DTI is 40%. Many lenders prefer a DTI under 36%, meaning even someone with a near-perfect credit score like Mark can be flagged as higher risk if their debts are too high relative to their income. Another common misconception is that your credit score alone determines the loan terms you'll receive. It doesn't. Lenders look at income stability, including how long you've been at your current job and sometimes even what field you work in. They check recent hard inquiries because multiple inquiries in a short period can suggest you're desperate for credit. They examine your credit mix, the variety of accounts you hold, such as credit cards, auto loans, personal loans, or mortgages, because a borrower who responsibly manages different types of debt is often considered lower risk. They also look at length of credit history, because someone with a 20-year track record of on-time payments is generally less risky than someone with a 5-year history, even if both have similar scores. Many people also assume that paying off all your debt immediately will make you instantly more attractive to lenders. The truth is more nuanced. If you close old credit accounts to pay off balances, your average credit age decreases, which can temporarily reduce your score. Similarly, maxing out credit cards, even for short periods, spikes your credit utilization rate. Utilization is the percentage of your available credit you're using, and lenders generally like to see it below 30%. Even if you pay off the balance every month, a temporary spike can signal higher risk. What this shows is that credit scores don't always tell the full story. Behavior and context matter just as much, if not more. Let's take another example. Emily is 28, has a credit score of 690, which is considered good but not excellent. She earns $6,000 a month, has a mortgage, a car loan, and a small credit card balance, giving her a DTI of 25%. When she applies for a personal loan, she's approved at a lower interest rate than someone with a 750 score but a higher DTI. Why? Because lenders care about the overall risk, and Emily's debt load is manageable compared to her income. This is why a lower score doesn't always mean worse borrowing power. Sometimes, someone with slightly lower credit but a better financial profile is more attractive to lenders than a perfect score with high debt. There's also a widespread myth that having multiple credit cards is bad. In reality, a diverse credit portfolio can be a sign of responsible financial behavior if managed correctly. Lenders like to see that you can handle different types of credit over time. But it's important to manage utilization and avoid unnecessary hard inquiries. Opening too many new accounts at once can be interpreted as risk-taking or desperation, and closing old accounts can shrink your credit history, affecting your score. Again, this proves that your number alone doesn't tell the whole story. Now, let's talk about the practical numbers behind credit scores. Payment history accounts for 35% of a FICO score. Amounts owed for 30%. Length of credit history, 15%. New credit inquiries, 10%, and credit mix, 10%. That's the formula lenders use to create your score, but it's not the formula they use to approve or deny loans. They weigh other factors heavily: income, employment stability, savings, and your total debt obligations. In fact, a person with a 700 credit score but a DTI of 45% may be rejected for a mortgage, while a 680 score borrower with a 25% DTI is approved easily. This is where the credit score lied to you perception comes from. It's not lying, it's just incomplete information. So, what should you focus on if you want lenders to see you favorably? Start with your debt-to-income ratio. Keeping your monthly debts well below your gross income, ideally under 36%, is one of the most powerful levers you can control. Next, maintain long-standing credit accounts and a healthy mix of credit types. Avoid frequent credit inquiries and manage revolving debt so utilization stays under 30%. Pay bills on time, yes, but also think about the bigger picture, how lenders see your financial stability over years, not just months. Timing, consistency, and patterns matter far more than chasing every point on your score. Here's another reality check. Credit scores don't account for emergency savings, investments, or overall net worth. A person with a 750 credit score but no savings and maxed out credit cards is riskier to a lender than someone with a 680 score but an emergency fund covering 6 months of expenses and low debts. Lenders are assessing risk, not morality, not intelligence, and not your financial dreams. They're looking for signs you can repay what you borrow. The good news is that understanding what lenders actually check gives you control. You can't fake income or job stability, but you can manage your debts, maintain long-term credit, and strategically use accounts to demonstrate responsible behavior. Mark and Emily adjusted their finances, monitored their DTIs, and a year later qualified for loans at much better rates than they expected. The credit score didn't lie, it just wasn't telling the full story. One of the most important insights is that credit management is a marathon, not a sprint. One missed payment can hurt temporarily, but consistent, responsible behavior over years is what lenders reward. The quiet, disciplined approach, paying debts, keeping utilization low, holding accounts open, pays off more than obsessing over incremental score changes. So, if you've been obsessing over your 3-digit score, take a step back. It's just one indicator. Lenders are looking deeper: your income, your debts, your employment, and your overall financial patterns. By focusing on what actually matters, you can make smarter decisions, avoid surprises, and finally use credit to your advantage instead of letting it intimidate you. Don't just chase a number, build financial habits that make your profile truly strong. You don't need to be smarter, you don't need perfect timing, you don't need a massive salary. What you need is patience, consistency, and the discipline to stay the course when nothing seems to be happening, when the numbers look small and the progress feels invisible. One day, without drama or celebration, you'll realize your financial behavior and strategic decisions have positioned you in a place where your credit works for you, not against you. In that quiet moment, everything changes. If this helped you see credit differently, take a moment to think about where you are in your journey. Not where you wish you were, but where you actually are right now. Stay consistent. Stay patient. Keep managing your debts, monitoring your accounts, and thinking like a lender. Don't quit during the quiet phase because that's usually right before it starts to work. Your credit score may not tell the whole story, but your actions absolutely do.